right now, there's a massive disconnect happening inside the AI market. On one side, trillion-dollar AI companies are dominating headlines, attracting billions in institutional capital and leading the entire technology narrative. But underneath that wave, there are smaller AI companies trading at prices most investors would never take seriously. One of them is trading at just 0.21, and another is sitting around $2.07. Now pause for a second, because here's the real question. How do companies connected to enterprise AI systems, government intelligence layers, and AI-driven analytics end up trading at levels that look disconnected from the broader AI boom? But here's the catch. What if the market isn't just mispricing companies? What if it's mispricing the infrastructure layer underneath AI itself? Because while everyone focuses on chatbots and mega-cap AI stocks, a quieter expansion is happening behind the scenes. And this is where things get interesting. AI is no longer just becoming a software trend, it's becoming infrastructure. Enterprise systems are integrating AI into analytics workflows. Governments are adopting predictive intelligence tools. Media systems are automating content analysis. Data processing layers are becoming increasingly AI-driven. And this is where pricing inefficiencies usually exist, because retail attention normally chases visible AI winners, while institutions quietly monitor the infrastructure layers operating underneath the expansion. This is the type of layer institutions quietly watch. Now, this doesn't guarantee anything. These are still small-cap companies. Volatility remains high, execution matters, timing matters. But it explains why this area matters. Because if AI adoption continues expanding deeper into enterprise systems, analytics platforms, and intelligence infrastructure, this is exactly where smaller cap opportunities tend to form. Most investors think AI is only about chatbots and automation tools. But one of the fastest growing layers in the market is something far less visible. AI-powered intelligence systems designed to process massive amounts of political, regulatory, and enterprise-level information. And this becomes extremely important in environments where decisions move quickly and information changes constantly. But here's the catch. Most retail investors never look at this layer because it doesn't feel exciting on the surface. And this is the part most people miss. The companies handling information infrastructure often become more valuable only after adoption becomes deeply integrated into real-world systems. Now, interestingly, the second stock we'll discuss later approaches AI from a completely different angle: enterprise media and analytics automation. This company operates in the AI intelligence and policy analytics layer. That includes regulatory monitoring, government intelligence workflows, enterprise-level information systems, AI-assisted analytics platforms. As governments and corporations become increasingly data-driven, the demand for faster intelligence processing naturally grows. And if this layer expands, companies like this become critical. Because AI adoption is no longer only about generating content. It's becoming about processing complex information faster than humans can manually handle. This stock has already experienced a dramatic collapse cycle. It previously traded above $10 during earlier growth optimism, then declined aggressively as sentiment towards speculative tech weakened. Now shares trade around $0.21. Now the question becomes, is this simply another broken small-cap stock? Or a pricing disconnect tied to a neglected AI infrastructure layer? The company focuses on AI-driven intelligence platforms used for policy monitoring, enterprise analytics, government workflow systems, real-time information processing. Its entire business revolves around transforming large-scale information into actionable intelligence. And when you actually look at the company behind this is where things shift. The stock is Fiscal Note Holdings, ticker note, currently trading around 0. So why is it still trading at these levels? Because markets remain skeptical towards smaller cap enterprise software and intelligence platforms. Revenue scaling concerns still exist. Market confidence remains fragile. This doesn't mean it moves tomorrow. There are real risks here, and timing is the key factor. Now, before we get into the second stock, here's something most people completely overlook. Even though AI demand is exploding globally, many enterprise AI infrastructure companies are still seeing delayed price reactions because markets continue prioritizing consumer AI narratives first. And historically, that's exactly where pricing gaps tend to form. But unlike the first company, this one operates much closer to enterprise automation, media intelligence, and AI-driven content analytics, where the first stock focuses on information intelligence systems. This company focuses more directly on AI-powered operational workflows. And this creates a completely different type of opportunity. This company develops AI software tools used for media analysis, audio intelligence, AI-powered search systems, enterprise automation workflows. In simple terms, it helps organizations process and analyze large amounts of content using AI systems. And as enterprise AI adoption grows, automation layers like this become increasingly important. If AI adoption continues expanding across enterprise systems, then companies building operational AI infrastructure naturally become more relevant. Because eventually, businesses don't just need AI creation tools. They need AI workflow systems capable of processing information at scale. And this is where enterprise infrastructure starts becoming critical. This stock has also experienced a massive valuation shift. Shares previously traded above $40 during earlier growth cycles, then collapsed as speculative technology sentiment weakened. And now, the stock trades around $2.07. Now the question becomes, is the market permanently discounting this company, or simply waiting for enterprise AI adoption to accelerate further? And this is where it gets interesting. The company is Veritone, ticker VERY, trading around $2.07. But here's the reality. Enterprise AI infrastructure companies still face uncertainty around profitability, execution, and long-term adoption speed. This doesn't guarantee anything, and there are real risks here. But market gaps often exist where visibility remains low. Now compare both companies carefully. One operates in AI-driven intelligence and policy systems. The other focuses on enterprise automation and content analytics infrastructure. One trades near penny stock territory at just $0.21. The other already sits above $2 after attracting more enterprise AI attention. So, which one benefits faster if enterprise AI spending accelerates? If governments and enterprise institutions prioritize intelligence processing systems? The first company could benefit from growing information complexity. But if operational AI automation scales faster across enterprise environments, the second company may gain visibility more quickly. And this is the part most investors miss. Infrastructure layers usually move later than hype cycles, but sometimes much more aggressively once adoption becomes visible. At the end of the day, both of these companies sit inside the same broader category, AI infrastructure. Not flashy consumer AI, but the systems operating underneath enterprise and intelligence expansion. And historically, this is the layer that tends to move later, but often more aggressively once institutions begin pricing future adoption more seriously. If you want more breakdowns on overlooked AI infrastructure stocks trading under the radar, subscribe, because the next phase of the AI market may look very different from the first.